In this video, I'm going to break down how to find inverse fair value gaps, how to actually trade them, and how to use confluences like liquidity to make sure that your inverse fair value gaps actually hit 80% of the time. We're going to be breaking down liquidity, fair value gaps, inverse fair value gaps, all in one video, so make sure you watch all the way to the end because I'm dropping a free course going over everything from A to Z, and if you want access to it for completely free, I'm going to show you how at the very end of the video. Alright everyone, welcome to this video. It's going to be a very simple and straight to the point video. So today we're going to be talking about inverse fair value gaps. I know it says invest here, it's supposed to say inverse, but by the end of this video, you're going to understand the basics of trading inverse fair value gaps, how to use liquidity sweeps in unison with inverse fair value gaps, and be able to use them effectively in your trading journey. The reason I say effectively is because a lot of people, they just assume there's a fair value gap, it inverses, and that's your entry every single time for a play. And that's just not true. You have to use liquidity and sweeps of liquidity in order to actually trade inverse fair value gaps properly. You need to be able to trade the sweeps and trade them to an area of liquidity. But to do all that, you first have to understand what is a fair value gap. So before we get into trading inverse fair value gaps, it's important you understand what a regular fair value gap is. A regular fair value gap is an imbalance in the market where buyers or sellers take control of the markets. When the market is moving up very consistently or down very consistently, that is an imbalance in the market. All right? When the market is moving side to side like this and buyers and sellers cannot figure out who's in control, this is a balanced market. So, to find imbalances, we use a 3-candle pattern to find these imbalances, and we mark them on our chart. So the important thing to note is that the candle that the gap is drawn is always a strong candle. This candle is only a candle that institutions can form. And the reason institutions form this is because the candle will look something like this compared to smaller candles like this leading up to it. And this is what creates the gap for us. And the reasoning we'll dive into deeper in the next few slides. But this candle is only able to be made by institutions because it requires a large amount of volume. Remember, this is a battle between buyers and sellers, and only institutions are the ones who have enough buying power to actually create an imbalance in the markets. So moving on, here's an example of a fair value gap. Notice that it's a 3-candle pattern. Candle 1, candle 2, and candle 3. Okay? We have a small, almost doji-like candle. Then we have a strong red candle following. Then we have an even smaller doji over there. The dojis don't matter. All that matters is that strong candle which creates an imbalance in the markets for the sell side. This is a fair value gap. Continuing, how do fair value gaps work? Knowing how to find fair value gaps is only half the battle. Understanding why they work is equally as important because it creates conviction when you're trading. A lot of times what a lot of traders have is they learn a concept, but you guys don't understand why that concept works, and that's the reason you don't have conviction in your trades. So in order to provide that conviction, we're going to go over how they work. And as you can see in this example, look at where the fair value gap is created. On a strong red candle. There's a clear imbalance in the markets. That's something you guys should take note of. So here's the analogy I like to use when it comes to fair value gaps. Imagine you have a paint roller. You dip it in the paint, and then you start painting a wall. So let's just say you have a wall here. Well, my drawing went a little crazy there. But let's assume you have a wall. And in that wall, you start slowly painting. You're slowly painting it. And then, out of nowhere, you move the paint roller super fast higher. Right? That's going to leave blotches and gaps in between where the paint should be. So what do you have to do? You have to dip back into the paint roller and slowly paint over those areas very carefully and go from there. Because you left unfilled gaps in the paint because you used too much force and too much speed, causing gaps in the paint, to fix that, you have to go back over it, fill the gaps, and continue painting. Do you understand how fair value gaps work a little bit now? Just off that analogy. Do you understand how the market makers, what they do is the market is ranging and they imbalance the market, something like this. And since it moves so fast, there's orders left behind, unfilled orders that have to cause the market to come back, fill those orders, and then move higher. And that is usually inside of a fair value gap because that is where the imbalance left orders. Continuing on, let's look into liquidity. For liquidity, we're mainly going to use previous highs and previous lows as known swing points as areas to target. There's two things the market will always do when it reaches a previous high or low. One is a sweep, and the second is continue through. Now, the one I want us to focus on is sweeps. When it comes to sweeps, we are usually framing for a reversal. So what does a sweep look like? Say this is how the market's reacting. We have this previous high here. Say the market continues to this high. And instead of breaking and continuing higher, it breaks and immediately fails back under. This is known as a sweep. What most people are trained to do is they assume that the market moves like support and resistance, how many of you guys were taught, right? So let's draw that back. Many of you guys, this is what you're taught. You have a clear resistance market, retest, and continues higher. How many times have you bought on the break of a previous high only for it to fail? How many times have you guys been caught buying up here? Many times, I'm going to assume. With sweeps, we're reframing for a reversal. Whereas a continuation, a strong close above, we're continuing the trend. Here's an example of a liquidity sweep. Most of you guys have been taught that this right here is an area of support. But you can see when the market continues this area, instead of continuing lower, following this trend, it sweeps this low and then moves higher. That's what you guys need to take note of. So we're looking for a liquidity sweep and a fair value gap to get invalidated for a move higher in this specific scenario. So getting into inverse fair value gaps, an inverse fair value gap is when a regular fair value gap is invalidated. An invalidation of a fair value gap can be used as an entry. Invalidation of a bearish fair value gap is bullish. Invalidation of a bullish fair value gap is bearish. So here's an example. Over here, you can see we had a previous high that we had swept. This high was swept as well. We had swept this high. We had a strong green candle here creating an imbalance with the 3-candle pattern. We had a fair value gap. Since the market swept this high and we took out this liquidity up here, we're going to go for the lows, most likely. Our entry would be a close under this fair value gap. The invalidation would be our entry. Stop loss at this high, targeting this low, and then targeting this fair value gap down here. This is a great example of a fair value gap that was invalidated that we could use as an inverse fair value gap because we used liquidity in conjunction with the actual fair value gap. So continuing on, it's important to note that inverse fair value gaps should only be used in conjunction with liquidity sweeps. Here's the checklist for a proper inverse fair value gap trade. Number 1, there needs to be a sweep of liquidity. Number 2, there needs to be an inverse fair value gap. Number 3, there needs to be a clear draw on liquidity, which is a previous high or low, as we mentioned before. Here's an example of a long that we actually took a few days ago. Here we have a sweep of liquidity. Here we have a fair value gap that's invalidated. here was our entry, and we were targeting this high, and then an hourly high that was all the way up here. That's an example of a bullish inverse fair value gap. Over here, you can see our short entry. We had a sweep of liquidity, inverse fair value gap, targeting this low. We entered here, stop loss at this high. We were able to catch a nice 2-to-1 risk to reward to the downside. Now, I don't have my face cam on for this video, but I know a lot of you guys stuck around because you want to see the free course. The first link in the description will be a sign-up sheet for the free course. It's not going to cost a single dollar. It's going to be completely free, and we're going to be going super in-depth about these sort of concepts and how I trade them to be able to get results in the markets. So if you guys are interested in that, click the first link in the description. The second link will be where you can join my Discord and live trade with me every single day. And that's it for this video. If you guys appreciate that I was super straight to the point, didn't bullshit, and we just got through the content very quickly. It might not be the most entertaining, but I just want to educate and I want to help people as much as possible. So I'll see you guys in the next one. Hope you have a great rest of your day.